Hi everyone, welcome back. This is part 9, and I hope I can make this the final part of this very long series. Let's dive right in. Last time we stopped at inventory, the second main driver of Tesla's operating cash flow. You can see here in 3Q there was some inventory buildup. It created a negative. For the 4Q, I expect a significant positive, primarily driven by the sell down of vehicle inventory. Here you see the inventory balance as it is shown on the balance sheet. Keep in mind this includes not only the automotive business but also the energy storage business. You can see here, I see I forecast a significant decline. This is basically then the release of the capital in the cash flow statement, the cash flow positive. Here we dive into sort of the components of the inventory balance on the balance sheet. As I said before, it comprises auto and energy and storage. You can see here that auto is by far the most significant part. It's 10.6 billion. Energy and storage is quickly growing and reached 2.4 billion in the fourth quarter by my estimates. The key components of inventory, and this is now mixed, so this includes both auto and energy and storage, that the key drivers are raw materials, finished goods, work in progress, and service parts. You can see, let's start with the smallest one, service parts. Obviously, as Tesla grows its global scales, this item keeps growing, so I forecast a sequential growth in 4Q, and for this reason, raw materials tend to slightly decrease in the fourth quarter. This is what I'm forecasting here for various reasons I can't get into because this will get way too long. And then finished goods, you see here a massive drop from third quarter reported almost 6 billion to what I forecast 4.4 billion. This is driven by the inventory sell down, vehicle inventory sell down. And then you have a work in progress. There's a lot of detail around this I can't get into, but it has to do with the fact that the Tesla Model Y is getting a refresh, and this creates various effects. But overall, we should see a significant decrease in inventory. That's the key takeaway from this analysis. And then when we look at how this is commonly analyzed in the automotive world, we use a metric that's called days of supply. Days of supply is simply calculated by the number of vehicles in inventory. You divide it by the number of vehicles delivered, and then you multiply it by the selling days. There's no globally consistent definition of this metric. Some people just use 70 days per quarter across the board, which technically isn't all that accurate. Some people, if they only look at an isolated market like the US, they look at the selling days in that market, but bigger picture, whether you use the exact days or 75 days, let's call it convention, doesn't make a huge difference. The key point is that when you apply a metric, the more important point is that you're consistent, because typically it's more about the trend rather than the precise absolute value. And then when we look at this chart, you can see here the reported 496,000 deliveries, the reported 459,000 production, which then tells you that Tesla sold off 36,000 units in inventory, and I estimate the inventory globally of Tesla to have dropped to just 75,000 units, or 11 days of supply, which in the automotive world is basically nothing. And the reason we discussed is to transition to the new Model Y, which is about to launch probably within the next couple of weeks. So, and then when we look at another major driver of operating cash flow, which is the add back of the depreciation charge, keep in mind we start with net income, and net income is after you deducted the depreciation charge, which is a non-cash item. And then obviously in the cash flow statement, because you want to work out the cash flow, you need to add back this non-cash charge. And because Tesla invests a lot in factories, equipment, AI, etc., so and that money, and when they acquire GPUs, when they acquire factories, they pay out the amount in full once it's completed the project. But they spread this cost over many years, and so what you see over time, the depreciation charge is increasing. So you can see this very clearly here. In 2022, Tesla booked 3.7 billion depreciation charge. In 2023, it rose significantly to almost 4.7 billion. And this year, the last financial year, 2024, it's probably close to 5.3 billion. So, but in the cash flow view, you have to add these amounts back. And then So now we discussed sort of the key drivers of the operating cash flow. We talked about in detail about depreciation and amortizations. Stock-based compensation is just the add back of this non-cash charge. The write-downs we touched on briefly. Then unrealized gains on FX is typically a smaller item, so is deferred taxes. And then there are some other non-cash interest in other items, typically not huge needle movers. Receivable we discussed in detail, which is a big item. Inventory is a very large item as well. Operating lease will be more significant this quarter because of the increase in leasing sales. Then we talked about prepaid expenses in other payables we also discussed in detail. And then deferred revenue, this is something I want to touch on briefly. So Tesla sells FSD, but FSD is not complete yet. So for the unsatisfied component of the FSD, and unsatisfied is a word Tesla uses in its SEC filings, Tesla creates a reserve, and that increase in the reserve is a liability. That increase is a cash flow positive. And so this shows up in this revenue line. And then there is also a deferred revenue component in the energy and storage business. So this is also like let's call it a permanent tailwind upon release of the reserve. So it's just the day FSD is like considered complete from Tesla's perspective, there should be a significant reduction of this liability as Tesla releases that reserve in the income statement. So the net income then goes up, and then this deferred liability goes down. So this number will go up a lot, and this number would then go down a lot. So it's kind of a wash in terms of cash because this cash has already been received. So and this then gives us the operating cash flow item, and now there's only one item missing so we can work out the important free cash flow number. Remember, free cash flow is operating cash flow plus capital expenditures, and because capital expenditures is a negative, it lowers whatever we calculate in operating cash flow line. So if we now look at capital expenditures, so here, capital expenditures, you always have to be very closely aligned with what management is guiding for, because you cannot just on numbers forecast what they spend on factories, etc. AI, you need to look what they tell you. And Tesla's guidance was capital expenditures in 2024 expectation of 11, that exceeds 11 billion. Exceed is an important word, and we have a very close detail what this meant in Tesla's case historically in a second. So in my forecasting, because they said it exceeds 11 billion, I forecast 2024 to be 11.3 billion. If this number would be closer to 11.8 billion, I would expect Tesla to predict capital expenditure of 12 billion or something. You would typically round to the next, like it is like the typical best practice finance stuff. So I won't get into detail, but this is probably a reasonable assumption. And previously I've been quite accurate with this. And so the implied, because we already know the first 9 months of 2024, the implied number from this assumption would be 2.7 billion. And the reason is here you can see the significant sequential increase because Tesla brought online a lot of AI infrastructure compute in this quarter, which created sort of this bumper 3Q capital expenditure. So we should see a reduction, because if you think about it, if Tesla kept this level in 4Q, this will completely blow this guidance out of the water. And keep in mind, excuse me, Tesla made this put out this guidance in October, so on as part of the 3Q 2024 disclosure. This is not old from the beginning of 2024. This guidance, this is relatively recent. So Tesla has very high visibility. So if we would keep this level, they would have said 12 billion for sure. Otherwise, this would be a lapse on Tesla's finance team's part, and I don't expect that that's the case. So then we look at sort of the historical perspective, how accurate has Tesla's guidance been, and the way this works is actually this line always shows you the guidance as of a specific quarter in the SEC filing for a given year. So for example, if we look at the Capex guidance for 2020. So the first time Tesla put out Capex guidance for 2020, sorry, for Capex guidance for 2022 was in 4Q 2021. And first it was 6 billion. The next quarter in 1Q 2022, they said the full year 22 would be also 6 billion. Then in 2Q, they increased it to 7 billion, kept it in 3Q for 7 billion. And then later, what they actually spent on Capex ended up to be 7.2 billion. So it was near completing the year. this was fairly accurate. The initial guidance wasn't that accurate because they spent basically 1.2 billion more than what they had initially guided for. But keep in mind, this was like over a year ahead, so this is hard to forecast. Obviously, a lot of inflation, etc. And then obviously plans will have changed. And then when we look at how did this metric develop in 2023, so the first 2023 guidance we actually also got in 4Q 2021. This used to be 6 billion as well. Same, then Tesla also started to increase it, blah, 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 blah. And then the last increase we saw in 3Q, Tesla moved it from 8 billion to 9 billion. And then in 4Q, with the reported number, we had the full 23 year reported, and the full year ended up just under 9 billion, guided at 8.9 billion. So because we don't have the fourth quarter yet, we don't know what the reported capex is for the full year 2024. But when you look at these two historical trends, first key observation is over time capex has always trended up. Second observation is that before the guided year is just in the last quarter, before the guided year is complete, Tesla gives us a fairly accurate number. There's just a small deviation here, a slight underestimation here, a slight overestimation. So that's why I feel very comfortable that my full year capex guidance for 2020 is probably quite accurate at this point, because I base it here off the 11 billion. And then Tesla also provides some guidance for 2025, and you can see how this has trended. Tesla increased it here. The most recent one is 9 billion, so this would be a decrease. So that's quite interesting. I will dive into this in detail, what this might mean in the future. And here's the sort of an outlook, and then we have no guidance at all for 2027. So then before we move into free cash flow, because now we have all the components, we just look at the capex, how it's trending on a trailing 12 months is a common way how to look at stuff. A lot of budgeting happens in sort of annual sort of time horizons for various reasons. And so it's often useful to see just a trend. And you can see this is my forecast, 11.3 billion for this year. And you see how sequentially this is always increasing, which you would expect in a quickly growing business. Tesla's, of course, Tesla's top line didn't grow very much in 2024, but I discussed before the reasons. But 2025 will be very different. And over here, I clipped a chart. This is a chart from Tesla, not one I produced, and this is what Tesla reported in terms of available compute. And then you see how in the third quarter the compute massively spiked up, and this is also why we had this massive spike up in capital expenditure. The Tesla brought online a lot of AI compute infrastructure, and so this increased the Tesla's available compute capacity, which is a key metric to keep in mind. But then we also see that the compute build out Tesla expects to slow in the fourth quarter, and this also sort of corroborates my sequential reduction in capex assumption. So there's less compute coming online. So I expect Tesla to give us a new version of this chart in the upcoming shareholder deck end of January. So it's going to be very interesting. I will report on that. And then we get to free cash flow. So, and free cash flow, as I pointed out earlier, is kind of the ultimate metric in a company. And here I just touch again on the calculation. Operating cash flow plus capital expenditures equals free cash flow, so item A less item F. And for the fourth quarter, I expect, despite the auto ASP reducing so much, for all these drivers I explained in great detail, I expect actually a slight sequential increase, and Tesla will come in at 2.8 billion. I think I'm significantly ahead of consensus at this point. However, consensus is forecasting of this item has been quite hit and miss in prior quarters. I think this is simply because many analysts simply don't go into this level of detail I do in terms of cash flow forecasting. The reason I know, or the reason why I think that's the case, because in my prior life as an investment banker, I had access to a lot of analysts' models, and I looked at how they model different things. And what I noticed, depending on the industry, the cash flow modeling was very rudimentary. They typically use high-level assumptions for example, a cash conversion factor or something. To be honest, I sometimes use this too as a simplification, but for other types of business. For example, when I do a NVIDIA forecast, a cash conversion factor yields relatively good results. In NVIDIA's case, the cash flow. Yeah, I'm not going to get into too much in detail here, but cash flow is a detailed cash flow forecasting, as it's necessary in Tesla's case, is not that important in NVIDIA's case at all. So long story short, cash flow is very strong. So the 2.8 billion, how does it stack up compared to other automotive or firms globally? This is very, very good. And Tesla will be, we don't have obviously disclosure for 4Q, but if I had to guess, I would, if there was like a poly market bet, I would bet Tesla would likely come in as likely top 5 company amongst the top 35 global automakers in terms of cash flow, if not better. So, but we'll see in a couple of weeks. Well, it will take a few months till we get all the cash flow disclosure from all the large automakers, but I will report back on that later. And here I just pasted again the cash flow bridge. So how you go from the 3Q operating cash flow to the 4Q operating cash flow, because it's a key driver. And you can see we have a reduction operating cash flow. So this item goes down, but then we have a meaningful sequential decrease in capital expenditures, and the net result is that we have a slight uplift in cash flows. This is my expectation. And then we see sort of the impact on the cash position of Tesla. So the cash position of Tesla is driven by free cash flow. So free cash flow, as the name implies, gives you an indication of sort of the excess cash generation, and the cash has to go somewhere, and the cash goes into the balance sheet and goes into the line items, the cash and cash equivalents. And depending on how much the CFO decides he wants to shuffle into short-term investments, it also sits in short-term investments, as we discussed earlier. It's usually short-dated government bonds, or it can be also other types of high rate. This can also be other types of highly rated bonds. But I expect Tesla to report an all-time high cash position. But cash position can also be boosted not only by cash generation, but also by financing activity. And Tesla did 2 asset-backed security issuances in fourth quarter. So this is a kind of obviously debt financing. And the cash Tesla receives by issuing these bonds also sits here in the balance of cash. And the point that is important is this amount obviously earns interest. In our income statement discussion, we looked at the interest income Tesla is earning, and this is actually quite a lot of money. For 4Q, I forecast just under 400 million in pre-tax earnings just from interest income on this giant cash pile. And this giant cash pile makes Tesla by far, no question, the best capitalized automaker globally. If you account for operating leverage, it's possible that some firms have a slightly higher cash balance, but not very much. I don't think there will be anyone reporting anywhere near 50 billion, even at 3 or 4 times the size. No, Tesla is by far the best capitalized company, the most liquid company technically. This is absolutely irrefutable, and the fact that Tesla still has a relatively low rating, despite this fact, despite strong free cash flow, despite very strong earnings power, is just crazy to me. But there are big rating agencies, S&P, Moody's, Fitch. To be honest, this year they have a really, really bad reputation amongst pro investors. I was investment bankers, and for us, they were just a nuisance most of the time. Anyway, so with that, I want to just quickly review sort of Tesla's this disclosure about their investments in AI. Tesla provides a nice breakdown of their investments. So all the capital expenditure, the Capex that we discussed before, basically increases these amounts on the balance sheet. There's property, plant, and equipment, it's called. But this also includes significant AI infrastructure. And you can see Tesla reported 3.7 billion in investments in AI infrastructure. I know some people throw around crazy numbers. Tesla invested 10 billions, etc. No. This is a poor understanding of the financial of Tesla. 3.7 billion is still a very large number, but of course it pales in comparison to like the hyperscalers like AWS, etc. But Tesla also doesn't have such a huge compute requirement, because Tesla is using the compute entirely in-house, and people like AWS build most of the AI infrastructure actually for clients to rent it out. So it's a huge distinction. So if you look at who is using the most in-house AI, this changes all the time, because you've seen Tesla brings online quite a bit of compute all the time, but Tesla would certainly rank amongst the top companies. And for Tesla specific use case, video processing, um, Tesla probably has for their use case the largest active AI infrastructure compute. Um, sorry, AI infrastructure. So here's just a consideration about Tesla's depreciation charge. Keep in mind, the depreciation charge lowest the profitability in the income statement by Tesla, and because Tesla is growing so quickly, is investing so much, there is a lot of undepreciated uh, assets on the balance sheet. So Tesla, on a like-for-like basis, simply has a higher depreciation charge than other automakers. So because of that, Tesla's profitability actually is weighed down a little bit compared to legacy. And for this reason, if, for example, Tesla reports an 18% gap gross margin, and you compare to another automaker, um, the Teslas should actually be looked at as stronger, even though the number is the same. This is just sort of a detail, but this is something only people who really know how this stuff works look through, unfortunately. And then we get sort of to the end of this presentation. Here, this is the financial summary that I showed in the beginning of part one of this series. Just as a recap, we have here the reported deliveries. Revenue as a result increases because we had this strong sequential increase and very strong a very strong energy storage increases. However, because of the weakness in average selling price in automotive business, despite the strong performance in energy and slight improvement in service and other, the total gross profit is basically constant, just 0.1% increase is my expectation. We talked about the operating expenses and why it's basically flat in 4Q, Q on Q, despite the volume increase in automotive. This then results in an operating profit that is basically unchanged Q on Q, at 2.7 billion. And then we discussed the non-operating item that is that for because this number stays relatively basically constant, the non-operating item this time around is actually an important factor, and we talked about it. It has to do with the expected absence of further restructuring charges. Also, the effect of foreign currencies on intercompany balances is easing based on my FX model, which has been highly accurate previously. So this provides us with a little boost here, and the net effect is then the profit after tax, assuming a constant tax rate, goes up by 7%, and this then drives a 7%, almost 10% sequential increase in EPS. There's some amount of share count increase, obviously, because ongoing issuance of share-based compensation. And then the free cash flow we just discussed also grows sequentially, so all good. So it's a very good financial profile. So in terms of margins go down a bit. We discussed ASP has a huge impact on that. Despite the very strong margins in energy, which I expect to come down because of competitive pressure and some one-off effects that were likely baked into this very high 3Q number. Service and other stays at a similar level to 3Q, and then net this gives us an operating margin of 10.2%, which is still very good, given that Tesla's dominant business segment is still automotive, and global automotive is in huge hugely struggles right now. I reported on all large automakers, and if you follow me for a long time, you have a pretty clear picture what's going on. So this is a very good number given what's going on. And as soon as sort of the struggle in the global automotive sort of eases, because it cannot continue forever, because cash reserves and financial profile of the companies would be eroded too much. Tesla will basically, first of all, the auto business will improve, and then of course there's so many other factors that will move Tesla away from being sort of mostly an auto company to more an energy storage provider, plus obviously AI product provider. And So with that, I want to end sort of this video series and leave you with this meme. Sorry for this. It's a bit graphic, but this meme is very important because it captures one very important reality about Tesla and especially the Tesla stock. It's very volatile, and especially when people are always very depressed or when the stock not always goes up, they feel like what you see here. They think like, okay, do something, especially when they look at other highly popular stocks like Nvidia, Palantir, and some other stocks I'm not going to go into. But then all of a sudden you have like recently an 8% day, and it blows everybody out of the water. Long story short, my Tesla price target is still in this $600 plus by year end 2025. I will provide a very detailed update of my 2025 price target once we got the 4Q SEC filings, plus of course almost no, actually more importantly, the commentary from management, their guidance for 2025. That is going to be very interesting. So subscribe, follow me on X or on YouTube, whatever you prefer. A lot more good stuff to come in 2025. With that, have a great week. Bye.